Keynes said four things which he thought were obvious. He said these were obvious ideas in the general theory. First, we don't know nearly as much about the future as we think we do, and therefore financial markets can crash. Alan Greenspan admitted the truth of this when he said that the crisis was caused by the, I quote, underpricing of risk worldwide. That could not have happened had financial markets been efficient. Second, Keynes said that when markets suffer big shocks, they don't self-correct quickly, but start shrinking like a leaky balloon as people stop spending. We have just experienced such a shrinking. In the last year, the American economy has shrunk by 7%. Americans are $800 billion poorer than they were a year ago. When America sneezes, this is still true today, the world catches a cold, and the world economy has deflated, more or less in line with America's. Britain's by 5.5%. Third, Keynes said that to make up for the decline of private spending, governments should inject extra spending into the economy. Keynes is the original inventor of the stimulus. This is in striking contrast to what happened between 1929 and 1932. Then, governments didn't believe that contracting economies might need stimulating. They did what they normally did, balanced their budgets and kept money tight, hoping that this would restore confidence. As a result, the American and the world economy experienced 12 successive quarters of contraction. This time, governments did the opposite. They did stimulate, and the contraction has been limited to 4 months, with green shoots of recovery, as everyone tells us, sprouting out all over the place. Finally, Keynes said that the market system needed central management if it was to work for everyone's benefit. There's one very important passage in the general theory which opens its last chapter, and in it Keynes wrote this: "The outstanding faults of the economic society in which we live are its failure to provide for full employment and its arbitrary and inequitable distribution of wealth and incomes." The bearing of the foregoing theory, that's the theory of the general theory, on the first of these is obvious, but there are also important respects in which it is relevant to the second. The general theory, in other words, sets out to explain the fact of persisting mass unemployment. Its subject matter was not the arbitrary and inequitable distribution of wealth and incomes, which we associate with the Marxist and more generally the socialist critique of capitalism. In policy terms, Keynes wanted governments to make sure that there was always enough aggregate demand, private and public, in the economy to maintain full employment. But he also thought it would be much easier to do this if wealth and incomes were more equally distributed. And I'll come to that later on. Let me elaborate on these 4 points, emphasizing their relevance to what is happening at the moment. The first concerns the volatility of investment markets. The whole of our investment machine works on the theory that we can accurately price risk. It is, if this were so, then of course, banks and companies would never go bust. Keynes made a crucial distinction between risk and uncertainty. We can accurately price some risk. We know we can. For example, the game of roulette is not subject to uncertainty. We know the odds. Similarly, with the chance of drawing a winning lottery number. We can accurately estimate the prospective returns on many kinds of investments over a specified period of time. But over a much larger class of investments, we simply don't know what the yield will be. Nevertheless, he writes, the necessity for action and decision compels us as practical men to do our best to overlook this awkward fact and to behave exactly as we would if we had behind us a good Benthamite calculation of a series of prospective advantages and disadvantages, each multiplied by its appropriate probability, waiting to be summed. The fact of our ignorance forces us to fall back on certain conventions, of which the most important are that the present will continue into the future, that existing share prices correctly sum up future prospects, and that if most people believe something, they must be right. Such conventions don't necessarily conform to any fundamentals that economists and business analysts love talking about. They're not external objective truth, but mental inventions of buyers and sellers. And Keynes particularly emphasized the state of confidence, a kind of socialized belief about what prices should be, which would be irrelevant, the state of confidence, if we had correct probabilities. Conventional expectations, he said, are compatible with a considerable stability in our affairs as long as the convention holds. But they are liable to sudden overturn when some bit of bad news comes, precisely because there is no firm basis of conviction to hold them steady. Then, and I'm quoting now, the practice of certainty and security suddenly breaks down. New fears and hopes will without warning take charge of human conduct. All these pretty polite techniques of the boardroom collapse. And this is exactly what happened last autumn. It was as if you're going upstairs in the dark and tread on a top step, which isn't there. Now, the banking collapse of last autumn opened an interesting debate between those economists, the vast majority, who believe that people's behavior is rational, and those who believe that it's irrational. Those who believe in irrational behavior argue like this: if people are rational, crashes can't happen. As crashes do happen, they must be irrational, at least some of the time. This seems to be the chief premise of behavioral economics. However, this sharp opposition between rational and irrational behavior is only plausible if one accepts a strong version of the rational expectations hypothesis. For Chicago economists, the rational individual is someone who behaves in accordance with a mathematical model of individual decision-making that the Chicago economists have agreed to call rational. And the most efficient application of that Chicago model is the efficient market theory. Believers in efficient markets hold that market participants have all the information needed to make sound pricing decisions, that they process this information efficiently, and trade establishes contingent equilibria between the opposing forces of supply and demand at each moment in time. Market participants do not make mistakes on the average, so that current asset prices correctly sum up future prospects. In other words, what Keynes called a convention, to disguise from us the fact that we don't know what the future will hold, is treated by these models as true statements concerning the path of share values over time. A model of this kind finds it very hard to account for large sudden swings in share prices. So, rational expectation hypothesis economists say that this must be due either to surprises or confusion or to irrational behavior. The assumption that even if the whole world is ignorant of the correct prices, these correct prices exist somewhere out there, jettison the premise of perfect or complete information, and the domain of rationality is liberated from its neoclassical chains. My dictionary defines rational as reasonable, using reasonable logic to think out a problem. Keynes asks, what expectations is it reasonable for people to hold in face of uncertainty? He argues that in most cases it will be conventional expectations, even herd behavior, that epitome of irrational exuberance, is reasonable if there's nothing more solid to hold on to. So he didn't abandon the rationality postulate. He simply asked how it would work if the future were unknown. And I believe that behavioral economics, despite its neurological insights, is not the key to any new economics that we need to develop in the light of what's happened in the last 2 years. Now consider that favorite of elementary economics textbooks, and I'm quoting from one of the most popular ones. When economies suffer a shock, wages and prices rapidly adjust, so there is continuous or almost continuous full employment. Yes, yet we know they don't adjust that quickly, and economists have invented a lot of fancy theories to explain what they call sticky prices. But it's Keynes's explanation that shines through most clearly. Prices are sticky, he says, because following a shock, no one knows what the new correct price is. Things have to settle down a bit before the new pattern of wages and prices discloses itself, and that leaves enough time for output to fall and heavy unemployment to develop. Now, I think this interpretation of the sticky price phenomenon was first put forward by Axel Leijonhufvud in the 1960s. I don't know whether anyone even knows about him today, but he was a towering figure in the economics of the, about the 1960s and 70s. And I think his interpretation is superior to those theories of imperfect information developed by later new Keynesian economists like Akerlof and Stiglitz. According to Leijonhufvud, the emergence of unemployed resources is a predictable consequence of a decline in nominal demand when traders don't have perfect information on what the new market clearing prices will be. In line with the Swedish school, Leijonhufvud emphasizes the fact that economic processes take place in time, and therefore, following a disturbance, the economy is in a temporary state of disequilibrium. Output and prices both adjust, but prices adjust slower than output because there's no what he called Walrasian auctioneer available to establish a vector of market clearing prices before the trading starts. No other assumption, he says, is needed to get from classical economics to Keynes, and I agree with that. Again, even here, uncertainty is the key to the successful analysis of sticky prices. Now, what about the third point, the need for offsetting government action when an economy starts sliding? Virtually everyone now accepts that shocked economies need some kind of stimulating to come back to life, to resume normal life. Even Robert Lucas, the high priest of Chicago economics, concedes that we're all Keynesians in the foxhole. Whether because of uncertainty, confusion, imperfect information, or whatever, unemployment develops, which may persist for a long time. And so there is a case for some government action. Now, Keynes gave an elaborate explanation of what he called underemployment equilibrium and how it gets established. And we can apply it quite easily to the present situation. And this is very elementary to people who are doing economics, but I think it's worth just mentioning because it's one of his neatest pieces of apparatus. We start from full employment, but with a large number of people highly indebted, and that's really the case today. This doesn't matter as long as there's a next step up the staircase. But suddenly the next step is no longer there, and a lot of people find themselves living beyond their means, just as Gordon Brown did. The only remedy they have available is to reduce their spending, to economize, to save. And in the last 12 months, the British economy has contracted by about 5.5%, or about £70 billion. That means that people's incomes have shrunk on average by 70 billion, and that means 70 billion pounds less is being spent compared to last year. Now, what happens if households and firms all try to increase their saving at the same time? Well then, total spending in the economy will fall even more, since everyone's spending is someone else's income. There will be even less demand for goods and services, and therefore for labour. In other words, our attempts to get back into balance by saving more will have made us all poorer, and in fact reduce the amount of saving as well, since we'll have smaller incomes out of which to save. So the economy will go on shrinking till the excess saving is eliminated by the growing poverty of the community. The essence of this insight, which I think is a very powerful one, is captured in the phrase the fallacy of composition. The fallacy consists in the belief that what is true of all the parts individually is true of the whole. And Keynes's most famous application of this was the paradox of thrift. More saving is good when the economy is overheating because it's a way of removing excess demand. But when the economy is sliding down, private virtue becomes public vice. And the correct response when an economy is going downhill is not to save more, but to spend more. That, in a nutshell, is the theory of the stimulus. Now, conservative economists have had to reconcile their acceptance of the need for stimulus in the foxhole with their dislike of any government activism. It's a difficult balancing act. Their solution is to draw on Milton Friedman's explanation of the Great Depression of 1929 to 1932. Following Friedman's lead, they explain the current meltdown in terms of the collapse of the money supply. They don't quite explain why this, but obviously mistakes in policy are always at the root of any conservative explanation of why markets go wrong, because by definition markets can't go wrong unless there are mistakes in policy. So the collapse of the money supply is due to some mistake in policy, and so they then argue that a sufficient condition for the restoration of full employment is a reversal of the collapse in the money supply. Hence, the only stimulus measure conservative economists approve of, and this goes for conservative politicians with a capital C, is quantitative easing, or more familiarly, printing money. A strange conclusion for conservative economists, only explicable because their hatred of governments outweighs their hatred of inflation. In December last year, Robert Lucas, again, I think he's an excellent source for many of these arguments because it shows I'm not inventing them, wrote a piece in the Wall Street Journal entitled "Ben Bernanke is the best stimulus right now," where he argued that the Fed's monetary policy had been the most helpful counter-recession action taken to date, in my opinion, and it will continue to have many advantages. It's fast and flexible. There's no other way that so much cash could have been put into the system as this $600 billion was, and if necessary can be taken out just as quickly. The cash comes in the form of loans, and this is the point. It entails no new government enterprises, no government equity positions in private enterprises, no price fixing or other controls on the operation of individual businesses, and no government role in the allocation of capital across different virtues. These seem to me, different activities, these seem to me important virtues. Now, there's also a debate going on about this now. And, you know, these are debates that this is why I don't think economics is really a science, because these debates are interminable. They went on at the beginning of the 19th century, they went on during the time of the Great Depression, and they've reappeared in exactly the same form today. Now, in a natural science, this doesn't happen. There are no believers in the theory of the phlogiston theory of energy, or in Ptolemaic astronomy any longer, but this debate, particular debate about the quantity of money, goes on and on and on. And in its present form, it's embodied, the quantity monetarist theory is represented by Tim Congdon. And I cite him because I've had a big argument with him about this. In a rebuttal of Krugman's defense of fiscal expansion, Congdon says that in the real world, non-fiscal influences, that is, quantitative easing, are much more important, powerful than changes in the budget balance. And for all practical purposes, fiscal policy is irrelevant. In practical terms, quantitative easing means that the central government just prints money. It purchases government paper and corporate bonds from banks and other financial institutions. The creation of this new money is supposed to speed the increase the overall money supply through deposit multiplication, encouraging lending and reduction in the cost of borrowing, and that stimulates new enterprise and so on. Indeed, in an email exchange, Congdon assured me that if policymakers boosted real money by 10% in 6 months, any economy will recover. And he challenged me to give a single instance when that hadn't been true. Well, we have an instance right now. Since March, the Bank of England has embarked on a 175 billion asset purchase program. It's actually put 142 billion pounds into the economy, extra cash, and that has failed to translate into increased lending. Of course, to some extent, the banks can be blamed for this. Cheap interest rates have been used to improve bank balance sheets. Since October last year, profit margins, measured as the spread between swap rates and the mortgage rates, has more than tripled. But this isn't the biggest problem. On the 4th of September, that is 6 months, Congdon's test, after the launch of the quantitative easing program, Stephen Major, head of global fixed income at HSBC, was quoted in the Financial Times as saying, "The vast majority of the liquidity is stuck in the banks in the form of reserves, but this is not about banks hoarding because they're afraid to lend. It is more about a weak economy where households and corporates do not want to borrow." This sentiment has been echoed by many others. People are in no mood to borrow, says John Wraith of RBC Capital Markets. It's not just banks hoarding. You can't lend if people don't want to borrow. And all of this was recognized by Keynes in 1932 when he wrote, "It may still be the case that the lender, with his confidence shattered by his experience, will continue to ask for new enterprise rates of interest which the borrower cannot be expected to earn. If this proves to be so, there will be no means of escape from prolonged and perhaps interminable depression except by direct state intervention to promote and subsidize new investment." And the reason for this is that in a recession, monetary policy alone can't get the long-term rate of interest sufficiently low to achieve full employment in the face of liquidity preference. And this preference, as the evidence shows, exists both on the lender and the borrower side. In other words, quantitative easing provides the fuel, but fuel alone cannot get the economic engine going. Confidence, the ignition of any economic activity, is being killed by uncertainty. And that's why quantitative easing has not actually stopped the slide. It may have made some contribution to it, and I'm not denying the need for quantitative easing. But if you say, well, why has the slide stopped? I believe there's a simple Keynesian explanation. Between February and September of this year, the monthly budget deficit went from 9 billion to 16 billion. This is a month, which represents an injection of 35 billion of extra spending in the economy. And I think that has been an important part of the stimulus. Far from being totally insignificant, irrelevant, useless, dangerous, as the monetarists say, it has been a material factor in stopping our slide down into the Great Depression. And conservative Treasury spokesmen like George Osborne, who demand a cut in government spending now, don't explain how this will help the economy to recover. The fact is that our economy is on a life support system, and it would be madness to withdraw it until we have substantial evidence of renewed growth, and that is whatever the cost of the drip. To summarize this part of the argument, you can see how uncertainty comes into Keynesian economics at various points. First, in explaining the instability of investment. Secondly, the uncertainty attaching to the failure of wages and prices to adjust instantaneously, and thirdly, uncertainty about the future course of interest rates. Today, these sources of uncertainty have been concealed by a veil of risk management strategies and an exaggerated belief in the market's ability to self-correct. Credit default swaps allow investors and money traders to insure against losses incurred as a result of bad decisions, and rational expectations are assumed to lead to near instantaneous adjustments of nominal variables. However, as our present predicament shows, the greatest challenge to our economic system is not risk. AIG and other insurers would have kept afloat if risk had been the only problem. It's uncertainty. The big question, therefore, is not how best to repackage uncertainty in the form of risk, but how to design an economic system which takes uncertainty seriously. Well, what of the future? I would pick out two main elements in the Keynesian political economy, looking at a permanent system. The first, basic Keynesianism, maintain aggregate spending at a continuously high level. Hence, you need to re-establish in some form or other a full employment commitment. And secondly, as part of that, full employment is to be maintained by fiscal and not monetary policy. The Keynesian recipe was to raise taxes in a boom and lower them in a downturn. He didn't believe in using interest rates for cycle control, precisely because he thought it would be difficult to get long-term rates down once they'd become too high for changed conditions. Am I simply an unqualified admirer of Keynes? The answer is not entirely. There's no doubt that Keynesian policy as applied in Great Britain in the 1950s and 1960s relied excessively on fine-tuning, and I don't think we should follow that route today. Secondly, I think it was missing an absolutely crucial piece of you might say, economic theory, and that is the theory of the natural rate of unemployment. That was the essential contribution of Milton Friedman, who always described himself actually as a Keynesian, though it's often forgotten. But if that had been there, I don't think governments in the 1960s would have tried to maintain an over-full rate of employment by trying to use prices and incomes policies, which couldn't work and discredited Keynesian demand management in the 1970s in a way I'll explain later. Now, the second element, I think, in the Keynesian political economy, Keynes thought that full employment would be much easier to maintain if wealth and income were more equally distributed, both domestically and internationally. Too much wealth piled up in too few hands makes economies unstable, and for that reason, Keynes would have favored a more equal distribution of purchasing power than we now have, and for much the same reason, he would have favored a more equal distribution of international reserves, something he tried but failed to achieve in his clearing union plan of 1941. And I'll be happy to answer questions on that, but it's too big a subject to go into at the moment. Now, let me, having talked about the ideas, wrong ideas is the explanation for the current mess, let me now turn to vested interests. In an essay I wrote on Karl Marx in 2000, I said that Marx's labor theory of value was dead, that his theory of the class struggle may have had some validity in the past but was dead also, but that in the event of large-scale economic crises, the discourse will change again. And that time has come. Keynes believed that the power of ideas, his own ideas, would kill Marx permanently. But he never considered the possibility that his own ideas might be at the mercy of changes in the power structures of Western society. If one were to attempt, however briefly, a structural analysis of the present crisis of capitalism, one might start with the balance of forces that existed to make possible Keynes's own revolution. As described by John Kenneth Galbraith, the post-war economies of the West, and he had chiefly the American economy in mind, but Tony Crossland applied it to the British economy society as well. The post-war economies of the West had three countervailing powers: capital, labor, and government. Now, today, just one of them, capital, remains the single prevailing power. And this brings one close to the conditions of the Industrial Revolution, which were brilliantly analyzed by Marx. Marx failed to see the unavoidable consequences of economic and technological revolution which were going on before his eyes. These consequences, as summarized by one economic historian, were the change of social stratification with the shift of political power to the middle classes and the rise of strong labor unions, capable of making their growing aspirations felt under a system of widening franchise. This not only democratized the spirit of modern government, but created the new administrative key position for a progressive control of economic by political forces. In other words, Marx missed the growth of a social balance between business, labor, and government. And this balance dominated the political economy of the 1950s through to the mid-1970s. But then it all changed. In a penetrating analysis, a Washington economist argues, before 1980, economic policy was designed to achieve full employment, and the economy was characterized by a system in which wages grew with productivity. This configuration created a virtuous circle of growth. Rising wages meant robust aggregate demand, which contributed to full employment. Full employment, in turn, provided an incentive to invest, which increased productivity, thereby supporting higher wages. But after 1980 or thereabouts, a new economic paradigm established itself, based on, I quote, asset price inflation, equities and housing, widening income inequality, detachment of worker wages from productivity growth, rising household and corporate leverage ratios measured respectively in debt income and debt equity ratios, a strong dollar, he's talking about the United States, but this applies pari passu to Britain as well, trade deficits, disinflation or low inflation, and manufacturing job losses. Workers were pressured on four sides: by globalization, by reduction in the size of government, by the increase of labor market flexibility, and the retreat from the full employment commitment. Well, labor laws were weakened, and membership of trade unions was sharply reduced. Now, what accounts for this shift? I think this is a very, very difficult question to answer. And there are a number of causes, and I think the factors we should consider, they're not exclusive and they're not to be considered in isolation from each other, are as follows. First, the consolidation of big business and banking. The degree of concentration has increased. For example, 5 banks control over 80% of UK lending. We were told that we were creating competitive markets in all our deregulating policies. In fact, we created a global network of interlinked oligopolies. Second, there's been a major political shift. There was a major political shift towards the right, and in the UK, at any rate, this was largely influenced by hostility to over-powerful trade unions. There was what undoubtedly happened in the 1970s was an increase in the monopoly power of organized labor, which turned people against the unions, even their own members. In other words, in the 1970s, the trade unions threatened to become the prevailing power. Labour government programs in the early 1970s, and I lived through that period, envisaged a trade union state, or trade union state system of government to run the economy, with only a minor role left for private business. And Thatcherism was the political reaction to that. So I think there was a political shift, just because the Keynesian consensus, which had sustained the balance of the post-war economy, had started to break down when the balance started to break down. Third factor, globalization. Globalization was based on the export of manufacturing jobs where unions were strong, and rebuilding the economy on the basis of service industry where they were weak. Globalization was the business response to the declining rate of profit, which Marx predicted. It was seen as the master key to overall improvement in the position of the business class. Globalization increased corporate profits, reduced the prices of consumer goods, and made possible a huge influx of outside money into the Western banking system. But most important, it was used as a bludgeon to frighten workers and to emasculate their economic and political power. Interestingly, Marx supported free trade because he wrote, the free trade system is destructive. It breaks up nationalities and pushes the antagonism of the proletariat and the bourgeoisie to the extreme point. In a word, free trade hastens the social revolution. These warnings were ignored by the creators of the Washington Consensus. Then a fourth factor, on the intellectual side, the rehabilitation of the market and the denigration of the state. The counter-revolution in economics, starting with Friedman and adaptive expectations and ending with the new classicals and rational expectations, all that rehabilitation of the market was a very important factor in the dismantling of the Keynesian system. Now, the rehabilitation of the market didn't entirely depend on new classical models. Also, there was a revival of Schumpeterian models. The idea that capitalism depended on creative destruction, on heroic entrepreneurs. Too much stability destroyed capitalism's dynamic. So we must, in the words of Meghna Desai, who's been a professor of economics here, and one of my oldest friends, so we must ride the surf and learn to enjoy it. Because unless we do, capitalism will stagnate. And coupled with this was the justification of super profits as the reward for super enterprise. Then I think a fifth factor, more institutional, was the hegemony of right-wing think tanks and journalists who simplified and popularized the academic celebration of markets and revulsion against big government. One consequence of all this was that the welfare state, as the basis of the social contract, was dismantled and replaced by access to credit. To quote one American analyst, maintaining growth of spending on consumption requires continued excessive borrowing and continued reduction in the savings rate. Continued excessive borrowing requires ever-increasing asset prices and debt-income ratios. Hence, the systematic need for bubbles, which eventually burst. Meanwhile, when the savings rate hits zero, little further reduction is possible. Consequently, both drivers of demand eventually exhaust themselves. So both at the top and at the bottom of this system in which median incomes had become increasingly sort of spread, you had speculation and over-leveraging. And the policy and the triumph of corporate globalization accelerated the process and transformed it into a financial crash. So where do we go at this point? It's probably impossible, as well as undesirable, to restore trade unions as a countervailing power in the Anglo-American type of economies, dominated by a service sector and high-tech manufacture. Though I think they do. There's much more of a balanced type of economy. Much more of a balanced type of economy of this kind survives on the continent of Europe, especially in Germany, but it's gone from the Anglo-American model. And I don't see how you can restore it in our type of economy. The liberal solution of breaking up concentrations of big business, trust busting, as the Americans used to call it, is probably unavailable in the increasingly integrated global market. Though I would go, if it were at all possible, for a restoration of the Glass-Steagall approach to banking. I believe that would be one way of trying to break up the corporate banking system and separate out different functions of banking. But no one is prepared to do that at the moment. And so what they're really talking about is something milder, which is some forms of financial regulation which aim to secure financial stability via either increasing capital and reserve ratios or using them counter-cyclically, so that in good times banks would be required to hold higher ratios, and in bad times they would be allowed to hold lower ratios. I mean, I think that's all helpful, but I think it doesn't quite get to the heart of the matter, because I think banks will actually be able to cheat on those. And I think they're cleverer than the regulators. What is capital? Can anyone define capital here? So if you talk about them, that the banks must increase their capital ratios, ratios to their deposits, they can always somehow say, well, this is capital, so I think the regulators will lose on that one in the end. Now, another argument is national states can't control global capital, and therefore there's nothing we can do because a world state is unavailable and probably undesirable as well. But a single world model of globalization is not the only one. It's far more plausible to think of global integration developing via regional integration. And that offers a more feasible route to reinserting democratic oversight of the economy. And I think the European Union is a very positive development. It hasn't got, there's no strong state there, but this seems to me to be one way in which, through the development of powerful regional bodies, that we can try to control global capital. But I'm not saying that we're there, and to get a system that doesn't crash every few years with increasingly serious social consequences does require an enormous effort of thought. Keynes repeatedly said that he had not come to destroy the market system. His aim was to make the world safe for markets and markets safe for the world. In certain crucial areas, particularly affecting long-term investment, we don't have these predictive tools available because there's genuine uncertainty. And I don't think we can develop models which deal which translate all uncertainty into risk. And therefore we have to do without it. Now, what are the consequences of having an economics in which uncertainty is taken seriously? That, I think, is one very important question. One thing that will, I think, comfort all or encourage all people who feel slightly challenged in maths is that, as I do, is that it will really encourage an economics which places less reliance on maths and places more reliance on other ways of understanding human behavior. And I have at the end of my book, I've got a rather brief sketch for how one could reform the teaching of economics. I think people have become rather interested in this, just because they think economics is useless for many crucial problems in the real world. It's fine for pricing a transport system or something like that. But I mean, the fallacy of composition is a very important insight that Keynes had, that the parts don't add up to the whole. You can't get the whole just from analyzing the parts. And so you've got to think about the distinction between microeconomics and macroeconomics very seriously, and not assume that you can get your macroeconomic outcomes just through the study of the assumptions that govern microeconomics, rational individual maximization. Now, I think, but it's not. I'm not saying I've got an answer to your question. All I'm saying is that the quest for an entirely predictable economics is a false one. Economics is not a natural science. It's not physics using different words.
Now, my question is, just how do we try to cut the current deficit without running the risk, that is, of deepening the recession?
No, the answer is you don't cut the deficit now. You allow it to expand to whatever level is necessary to make sure that we don't slide any further. You see, I think a lot of people don't understand this point, that obviously when you're at full employment, one set of rules applies, but when you're very well below full employment, you've got to overturn some of these. If I were a Conservative Treasury spokesman, I would have concentrated my attack on, I'm afraid, on Gordon's fiscal record before he became Prime Minister as Chancellor of the Exchequer. I think it was quite contrary to Keynes to enter a recession with a budget deficit as big as we had, and I think that has created confidence issues about the deficit which would otherwise not have been there. It was Keynes who said that a boom is a time for austerity at the Treasury. He wanted budget surpluses to be run during a boom, which would then be available for spending in a recession. And we didn't do that, and as a result, our fiscal position will be worse than it would have been. But the basic point is true. If you start cutting spending now, you're going to deepen the recession. And therefore you shouldn't do it. You should allow spending to increase. I think we probably need a further stimulus, but I don't know what all the figures are.
I only asked for the simple reason that there seems to be a kind of sort of Dutch auction between the parties to who's the bigger cutter.
Yeah, well, I think at least the Labour government says it's not going to cut now, which the Conservatives wanted to do. And I think if the Conservatives were in power, they wouldn't cut either. They couldn't afford to take the political risk of cutting. But they're not, and therefore their policies, thankfully, won't be implemented, or their avowed policies, for several months at least.
What do you see as the next bubble?
I don't have any basis for accurate prediction. Having said that no one does, it would be rather arrogant for me to claim that I do. We don't know. What we can be sure about is unless they fix the system in quite a radical way, we will just go from one crisis to another. I think what's likely to happen is that the recovery is going to be quite weak, and that there'll be another dip or two, and it'll be in the financial system itself. But I don't know exactly which bits of it, and I can't say when it would happen. One of the misconceptions, there's been quite a lot of discussion. Apparently, the Queen asked an economist at some reception. She said, "Why didn't any economist predict this?" And it was a good, very reasonable question. for someone who had studied new classical economics, which presumably she hadn't, but it was a reasonable question. But the real answer is it was unpredictable in terms of timing. It was one of those, you could call it a Taleb black swan. It was a sort of, it wasn't in the models that were being used at the time. And even Keynes couldn't have predicted it exactly. What he could have said, this system is sufficiently unsound for something like this to be always possible. And then when it happened, it wouldn't have surprised him. So the answer is I can't predict what or when the next crash will come. But I think unless we really take this one seriously and take the reform of the system seriously, it will happen again.
Is banking socially useless?
Wait a minute, I'm going to have the other question, so write that one down.
Yeah, if, as you just said, and the NIESR has predicted that we'll have a weak and protracted recovery, isn't this the reason that both parties, obviously the Conservatives principally, are very worried about the deficit? Because the growth is not going to deal with it, and basically this could result in a crisis of confidence, particularly in terms of those actually lending to government and the government's difficulty, difficulty in borrowing, and therefore obviously an increase in interest rates. Isn't that the reason why there's so much concern in Whitehall and in the Treasury about the deficit?
And then, here.
My name is Bernard Casey, and I'm actually from the University of Warwick as well. If it is a case that uncertainty exists alongside risk, and we cannot repackage uncertainty into risk, somebody has to manage that uncertainty. Who is going to manage that uncertainty, and whose ideas are going to drive them?
So now we've got three.
Is cluster three. Is banking socially useless? No, it isn't. It's very important because it's the conduit by which savings are transferred into investment, and investment is what drives the economy. What Adair Turner said was that a lot of the financial services, or the extent of the financial services, has ceased to be socially useful. They should be smaller. And I think I agreed completely with Gordon Brown when he said that finance should be the servant and not the master of industry, a phrase you can find in page 142 of my book. But anyway, it's always nice to have one's thoughts picked up in that way, though anyone might have really said that. But I think that's the important point. Finance has to serve the economy. It mustn't be master of it. And that means it shouldn't be as large, point one, in relation to the whole. And also rewards shouldn't be as large. These huge rewards which people in the financial services have been getting are premised on the fact that they're adding that amount of value to the economy. Now, if that's not the case, and I don't think it is the case, then I think they should be controlled. And there were many ways of doing it which aren't excessively penal or particularly penal at all. So the answer is yes. I think the City of London plays too large a part in the British economy. It also has this other effect, that it concentrates a huge amount of political power in one place, and that power should be dispersed over the whole economy. You know, it's the idea of trying to get a balanced economy. You just have one set of people who tell the government what to do, essentially, or what, if they don't do, they'll all leave the country and destroy Britain's only real engine of growth. And I think that's very unhealthy, because it does mean that the government is a servant of the bankers, and that they simply exist in order to guarantee banking profits. Now, I think we're uncomfortably enough close to that to make Marx a rather perceptive analyst of the way capitalism works, and I don't want to be there, and I don't think it's necessary. Second, weak recovery. Well, if the recovery is weak, does that increase lack of or reduce confidence in the financing of the government deficit? I don't think there is any real evidence at the moment that the government is finding it difficult to place its paper. I think this crisis of confidence in the finances of the government is a long way along the road. I don't think it's there now, and I think it's almost alarmist to believe that it is there. I think people have considerable confidence in the stability of government finance. Now, look at it in a comparative point of view. A lot of people are worried about the debt. But, you know, the worst projections of the national debt suggest that it'll get up to 80% of GDP. Now, we ended the Second World War with a national debt at 250% of GDP. In 1953, when it was down to 150, and those were the start of you've never had it so good years. No, I honestly think that's unduly alarmist. We're not a Latin American, as it used to be said, republic. Sorry, one can't say that today, but because Latin America has much better finances than it did in the 19th century. But the thing is, we're not heading in that direction, and I don't think we will. Who's going to manage uncertainty? That's a very good question. At least we start by recognizing its existence and don't think that our only task is to manage risk. Because if you read what they're writing about, they do never use the word uncertainty. It's all risk. Systemic risk. How can we manage systemic risk? The trouble was our system of control wasn't sufficient to manage systemic risk. Systemic risk. It's all risk. And if you go on using the word risk, you do tend to the belief that there is some super mathematical model that you can devise which can be applied macroeconomically, and that will eliminate systemic risk. Well, it's not the right approach. I would prefer to say, I don't mind about, I don't want to eliminate risk. I think risky, people should take bets. They should gamble, and if their gambles fail, they should go bankrupt. But what you can't allow is major banks to fail, and especially banks that whose deposits are guaranteed by the Treasury and therefore ultimately by the taxpayer. You've got to limit them. And once you recognize that a lot of what they were doing wasn't just risky, but it was actually playing with uncertainty. They didn't actually know what the value of their loans was, what the value of their insurance policies was. They didn't know what was on their balance sheet. Now that shouldn't be allowed, and you just got to stop it. So you can approach the management of uncertainty by simply stopping certain activities being done which would endanger the economy and which of their nature are uncertain. And the rest you can sort of allow to happen. I mean, I don't want to eliminate risk-taking. I don't want to eliminate people making fortunes and going bust. But they mustn't be in institutions whose activities can bring the economy down. They'd be fringe activities.
What do you think of option pricing models? And if you think they're dead, what do you think financial markets will do without them?
It may be a crisis of capitalism, but since there is no longer any alternative to capitalism, we still have capitalism after the crisis. The question I'd like to ask is, this seems to be the crisis of the US dollar as international currency. So what do you think is the future of the US dollar?
I want to ask a question. And my question is, does it matter what the stimulus is on and who makes the stimulus? In other words, that actually relates to the previous question.
Yeah.
Does it matter whether it's British spending or IMF spending or Chinese spending?
Well, you mean, does it matter what the stimulus is spent on?
Yes.
Okay. Yeah, I think it does. I mean, Keynes said, well, in purely macroeconomic terms, it doesn't. I mean, he said, if you can think of nothing better to do, you just bury banknotes in holes and dig them up again, or you spend it on useless things. The point is that it gets expenditure going, and therefore it lifts the economy, even though the initial money is spent on useless things. Provided, I mean, you could have. I think, had you last Christmas, had the Treasury had the brilliant idea of giving every single person in Britain a £500 Christmas present. Which would consist of a voucher with an expiry date on it, which could only be spent on buying British goods. That answers one part of your question. We wouldn't be in a recession today. Still, that depends on one or two assumptions, which are a bit dicey. But I mean, you know. It's a good thought experiment to think actually what would have happened had they done that. So I think it matters enormously what you spend it on, and I think that I would say that it would be much better to spend one's stimulus now on a medium to long-term investment program. Provided it could be started reasonably quickly. For example, there's a great big high-speed trade link that is now approved, running between London and Edinburgh, and I know Andrew Adonis has pressed that through the cabinet, and it's a very, very expensive program. The trouble is, you know, it may not get going quickly enough to have any impact, and that's always been the trouble with investment programs, which you have to devise when the recessions hit, because they start operating, you know, after the recession is over. So it's quite a good idea to have a portfolio of these investment programs, which you can sort of actually, for which all the approvals are already there, which you can implement fairly quickly. But we don't have that. But in principle, of course, you should spend it on things that will add value, social value to the economy, and bring about a rate of return. That's what the Chinese are doing now. So it's a partial answer to your question. The crisis of the US dollar, I'm taking them in reverse order. Well, this is very important. It's very important indeed, and I think that the global imbalances have been a major contributory factor to the crisis, because what they did was in a way, if you think of it in terms of a saving investment analysis, there are a lot of savings being done in China, and they somehow didn't actually produce American, the American investment didn't grow to absorb those savings. There was another kind of mechanism by which the Chinese government, central bank, bought US Treasury bills. And those had the effect of enabling Greenspan to run a very, very low rate of interest in the United States, because the US government could borrow from the Chinese, and therefore there wasn't a crowding out effect, which otherwise would have led to a rise in interest rates. So it was a mechanism for avoiding deflation in the United States, but at the cost of unbalancing the American economy even further. And it created asset bubbles in America rather than a steady growth of demand. The Chinese have been pressing for some internationalization of the reserve function, which would imply an end to the hegemonic role of the dollar as a reserve currency. The Japanese have been supporting them, but we're not nearly there yet, because I don't think you could have that rebalancing without some agreement on exchange rates. And we're simply not there, because what is the value of the what is the relationship of the currencies that would prevent global imbalances from piling up, either great deficits or surpluses? And we haven't begun to discuss that, though I think there is a working party on it. But the other thing is that the imbalances have suited both sides. And the Chinese have got export-led growth through an undervalued currency, as well as, in fact, some protection against another financial crisis, such as 1997 to 1998. And the United States have had the immense privilege of being the policeman of the world. And it suits lots of countries that America should actually be losing lives, defending freedom or whatever. The Russians, for example, are delighted that the Americans are in Afghanistan. So you can see there's a corrupt bargain here. So it has a geopolitical element as well as a straightforward economic element. And I think this is where we have to work on the intellectual structure of such a deal, because the two sides are fairly far apart. They both accuse each other of manipulating currencies. And they both say the onus of adjustment should fall on the other. This is a repeat, of things that really did happen, debates in the 1930s, which led up to the first Bretton Woods and to Keynes's plan to shift the onus of adjustment from the debtor to the creditor.
Yes.
And I think his scheme was immensely imaginative. The Keynes plan, it had a new international reserve currency. It had penalties on surpluses, both surplus and debtor countries, to reduce their surpluses and debts and deficits. And it was rejected by the United States. And what there was a compromise which left the dollar as the main reserve currency. It did have fixed but adjustable rates, which eventually broke down because a national reserve currency. A single national reserve currency, it destroys credibility in the currency sooner or later. Because you have to run a deficit in order to provide the world, with liquidity, and so we're back to this problem of how to deal with these. A system in which there is, I would call it symmetric non-adjustment.
Yes.
It's just blocked.
Yeah. And in the United States case, because it's the reserve currency, there's nothing that forces it to curtail its deficits.
Nothing that forces it, exactly, to curtail its deficits, to curtail its spending. You see, under the gold standard, if China had been accumulating reserves to the extent it has, that is, hoarding gold, and the United States had wanted to remain on the gold standard, then it would have had to have raised interest rates to try and get back, some of the money that was flowing out. But now it doesn't have to do that. It can do the reverse because, of course, the Chinese surpluses are partly invested in treasury. They're recycled. And that gives rise to a boom in the United States, which, from one point of view, can be regarded simply as an example of a Hayekian crisis developing over credit, leading to malinvestment, leading to collapse. But from a global point of view, is a saving investment problem. And so I don't think the opposition between Keynes and Hayek on this point is fundamental, although, of course, the protagonists of both sides say it is. In option pricing, could you just explain what you had in mind a bit? Well, it seems to me that all of these sort of option pricing models really depend on the assumption that you can accurately price them. I don't believe you can. I think many options you can't accurately price. And in fact, I mean, when I became director of an American mutual fund, I got lots of options, and I thought they were accurately priced. In fact, they're all underwater.
What do financial markets do if they don't work?
Well, they work some of the time because, you see, I think Keynes's point was, for a lot of the time, I mean, these constructions of pricing he called them mental constructions, and as long as the conventions supporting them hold, then they work. I don't think they tell you very much about whether shares are at securities are at their fundamental value, but if people believe that to be the case, then I think that's compatible with a lot of stability in the financial markets. They're not always all over the place. What he's saying is that because they don't actually, the pricing doesn't reflect fundamentals. In fact, we don't really know what the fundamentals are over any length of time, and perhaps not even ever. They're liable to sudden overturn because there's no steady conviction to hold them. And they have all kinds of techniques for pricing securities accurately, but they all tend to break down, and you suddenly realize, as Alan Greenspan said, that risk was underpriced worldwide. How can that be if there were accurate option pricing models? What do you do when you're in an era of abundance? Now, I'm using that word somewhat in inverted commas because I realize that you can't actually say how much welfare society has until you know something about the distribution of its income. Right. But using the word loosely, what happens to the economic motives of a society of abundance? Because the whole of economics is based on the notion of scarcity, and all its axioms, optimizing individuals and stable preferences, and all these things are actually based, especially the first one, on scarcity, the scarcity axiom.
Theories of international trade depend fundamentally on that for their conclusions.
So what happens when scarcity is no longer the most important driver of human behavior or economic behavior? And this was the subject of a fascinating little essay Keynes wrote, which I think has inspired me. It's inspired me quite a bit, called Economic Possibilities for Our Grandchildren. And I'm actually writing a book together with my son at the moment, who's a philosopher, called How Much is Enough? Economics and the Good Life, which takes up the question Keynes raised, what is wealth for? Looks at his predictions, which were that in 100 years the developed part of the world would have solved the economic problem. It would have a standard of life which was 4 to 8 times as great as it was when he wrote that thing in 1930 because of increases in productivity and capital growth and so on. And then people wouldn't have to work, or they'd have to work very, very much less. And therefore they'd take out increasing amount of their productivity gains in leisure. Well, that has happened to some extent, but not nearly as much as Keynes thought it would. And in fact, in the United States, after a long, prolonged period of a fall in hours work, from about 1980s, they started going up again. They fell to just over 2,000. And then they've gone up again. And that is a puzzle. Why have people gone on working more than they need to for the abundance which apparently they have? And why do societies differ in this? Because the Dutch only work 5/8 of the time the Americans work. And their standard of living isn't very much lower, or hardly, very, very, very little lower. But they've taken more out in leisure. Americans want more consumption. Why is that? I think Keynes understood that there were relative wants and that some wants were relative, but he thought absolute wants would trump the relative wants, and that at a certain point competition would be very much more restricted than it is in conditions of scarcity. I think the other thing which is very interesting about Keynes's utopia is that it has some resemblance to Marx's utopia. It's a utopia after capitalism rather than outside capitalism as the traditional utopias were. It has some resemblance to the hippies of the 1960s. They thought, the age of abundance. So there's Marcuse who comes into this whole thing, and I think Keynes sort of struck a Faustian bargain with capitalism, like Marx did in a way. Capitalism is necessary to bring us out of the tunnel of necessity into the sunlight of abundance. That's a phrase from the Economic Possibilities for Our Grandchildren. I would single out two. First of all, markets are not very stable. They're liable to crash. Especially that's true of investment markets. And secondly, when they do, and as a result of their crashing economies run down, the governments have a duty to provide a stimulus in order to break the fall and to promote recovery, because the markets won't do that themselves. So I think those are two basic features of Keynesian economics. That distinction between the psychology of the saver and the psychology of the investor is very closely connected with Keynes's distinction between risk and uncertainty. He did not think that the future was always merely risky, in the sense that it was like betting on things happening and being able to put numbers. In other words, having a set of probabilities about what would happen. He thought that a lot of it, and particularly when you were doing long-term investment, was unknown. You just didn't know what was going to happen. Of course, you invented various ways of dealing with that, but you didn't know. And therefore, he thought of uncertainty as being a very, very dominant impulse in human behavior, a dominant motive for human behavior. And when the future is uncertain, in that sense, he thought that a lot of saving would be directed towards securing getting more security in the present rather than building wealth in the future, which was the classical view. You saved in order to invest, in order to consume more later on. Keynes thought of saving much more as a kind of hoarding, or rather what he had called the propensity to hoard or liquidity preference would normally be stronger than the inducement to invest. And so that's the way he separated them out, via this crucial category of uncertainty. If you have no uncertainty, then of course the classical economics is true, and also a lot of modern financial economics. You have no uncertainty, you don't need, you have no problem of liquidity, you don't need to keep cash. Money has no utility in a certain world, whereas in an uncertain world it has a great deal of utility. As we have to act, we have to take views, and to say I don't know isn't really the basis for a decision. Unless we just act on caprice, but I mean, investors expect more than that. And so what people selling securities and anything else is, they do insurance policies, whatever. They invent numbers. Now, they're not inventing them in some sense of trying to cheat, but they are saying, well, let's start with some estimates. In other words, through something like using Bayes' theorem, we'll bet that it'll be like this, and then we look for evidence that confirms that. And so in a way they're trying to work out some risk premia that have some correspondence with actual risks, but they can't go very far that way. Along those lines, because the actual correspondence isn't really there in a lot of cases. So once people stop believing in these stories, then the crash can come very, very quickly. They believe that house prices are correctly priced for some time, and then suddenly they realize that there's no real basis for that. But what is the correct price? We don't know that either. It's just that everything swings. People suddenly cancel all their existing bets and want to get out. Now, none of that behavior seems to me to be explicable unless you have uncertainty there. And it's economics should start, I think, with the assumption that a lot of economic life is going to be uncertain. And therefore, what kind of economics and economic modeling and economic theory follows from that? We can certainly have an imbalance ex ante before the event, because in his equilibrium model, saving and investment are always equal by definition. But that's realized saving and investment. But before, as you're coming into your crisis, then there is an imbalance. People want to save more than others want to invest, and then he says, well, look. In classical theory, the theory he was combating, the theory of his day, what happens in that situation is the rate of interest moves immediately to adjust these two, this discrepancy, this ex-ante discrepancy, so that in fact everything proceeds smoothly, and investment and savings flow into investment smoothly. Whereas Keynes says, no, the rate of interest doesn't do this, because the rate of interest, what it equalizes is the desire to hoard money with the supply of money so that it can remain above what's necessary. It doesn't fall by as much as is necessary to equalize saving and investment. And so, in a way, that self-adjusting mechanism which classical economics had assumed to exist wasn't there. I know that's a bit technical, but all it means is that the government has to intervene at that point, that there's no automatic mechanism in a market system that reconciles the desire to save and the desire to invest. And therefore the government has to sort of do something, or the Federal Reserve, the Fed or the central bank or whatever, it has to intervene. Absolutely. I mean, it has to create enough investment, I would put it this way, for the economy not to suffer from a fall in aggregate demand. Because if you have a fall in the savings function relative to what people want to save, you then start having spending falling off, because that sort of portion of spending that is going to investment has decreased, and all. Now going back to the Archbishop, in a recent essay he called for a proper discussion of what wealth is for. Why is growth seen as the Holy Grail? Economics, he says, claims to have unearthed a particular theory of law of motivation which trumps everything else, that of self-interest. Rational self-interest underlies Adam Smith's invisible hand, but economic exchange, and then I'm quoting the Archbishop, is only one of the things that people do. And that's a very important phrase that he uses, only one of the things that people do. And then he says, why are we here? And he says it's to lead good and admirable lives. And the quest for wealth has only a limited connection with that. Moreover, maximization of wealth also calls for qualities which are the reverse of what is needed for goodness. So we must recover the courage to speak about these things, to speak about wealth and the pursuit of wealth in a moral and ethical framework. Now, both Smith and Keynes did that. I mean, with Smith, for him, economic life wasn't just one of the things we do. It was the main thing we do. And it's the main thing we do because of the universal condition of scarcity, what he called indigence. And so basically self-interest was something that was prime because it helped us solve this problem of self-interest. It wasn't just self-interest, there was also what he called sympathy. But indigence and necessity are the spur for improvement. Saving or parsimony comes to us from the womb. Self-interest is the motor of improvement, and it produces private property, which is the basis of the accumulation of capital and the division of labor. But it also, produces other things. Commerce and the arts of exchange come out of the quest for wealth. They make men sociable, and sociability is the basis of morality. Anyway, so you get this base superstructure sort of idea in Smith with self-interest as at the base, as necessary to get people out of poverty. Thus, the progress in civilization depends on progress in opulence. Opulence is produced by self-interest mediated by sympathy. Self-interest is innate, but sympathy is learned from the experience of living with other people. Now, interestingly, Smith didn't tell us what he thought life would be like after opulence was reached. I think he probably did have his utopia, but he did believe that it was the material progress of mankind which created intellectual and aesthetic appetites. So we must assume that Smith thought that one day economic life would simply become one of the things we do, as the Archbishop said, but it hadn't yet, that stage hadn't yet been reached. Now to Keynes, and I just want to take one strand of Keynes here, which is something I've been thinking about and working about recently, and that's his little essay, Economic Possibilities for Our Grandchildren. Keynes did speculate on what life would or should be when we'd reached a state of abundance. And he thought we were very close to it. This was written in 1930. His premise was that capital growth and improvements in technology were putting us within sight of solving the economic problem, at least in the West. A standard of living 8 times as high as in 1930 would be achievable within 100 years with a fraction of the effort, with the fraction of the hours that people then worked. Most work, in other words, would be done by machines. And so we would soon be in a position to abandon the morality born of scarcity. In other words, Smith's morality. With the economic problem solved, the Gradgrinds of the world will yield their places, and I quote Keynes, to the delightful people who are capable of taking direct enjoyment in things, the lilies of the field who toil not, neither do they spin. And significantly, Keynes said that once this point had been reached, we would be free to adopt the sure and certain principles of religion and traditional virtue. In other words, self-interest would be irrelevant at that point. In an era of abundance, like justice, self-interest would no longer make sense. And so the whole basis of our institutions would have to be transformed, and we would all suffer a nervous breakdown. Society as a whole. Now, in a sense, you might say, well, Keynes was simply following on from Adam Smith, only he was 150 years later, and the world had just become much more opulent than it was in Adam Smith's day. But there was one enormous difference from Adam Smith. Keynes did not see capitalism as benign, only as necessary. He was much more influenced by Mandeville and his fable of the bees. Mandeville's account of capitalism as a system which hypocritically turned vices into virtues. And he had little sympathy for Adam Smith's attempt to soften self-interest by the notion of sympathy. He would have agreed with Smith's contemporary Thomas Reid, who called Smith's philosophy of sympathy a delusive device for wrapping up selfishness in impartiality. So for Keynes, capitalism's only redeeming feature was that it got us to abundance. And for that we had to pay a very heavy price. And I just want to end here with a quotation from the Economic Possibilities of Our Grandchildren, which do show Keynes in his full flow and also reveal a great deal of the eloquence of his writing. When we get to the state of abundance, we shall be able to rid ourselves of many of the pseudo-moral principles which have hag-ridden us. I'm sorry, there's political incorrectness. Hag-ridden us, by which we have exalted some of the most distasteful of human qualities into the highest virtues. We shall be able to assess the money motive at its true value. The love of money as a possession, as distinguished from the love of money as a means to the enjoyment and realities of life, will be recognized for what it is, a somewhat disgusting morbidity, one of those semi-criminal, semi-pathological tendencies which one hands over with a shudder to specialists in mental disease. But that's when we've solved the problem. But beware, the time for all this is not yet. For at least another 100 years, we must pretend that fair is foul and foul is fair. For foul is useful and fair is not. Avarice and usury and precaution must be our gods for a little longer, for only they can lead us out of the tunnel of necessity into daylight. So that's Keynes on capitalism, the function of capitalism. Now, the Archbishop, Smith, Keynes, agree that wealth is simply a means to a good life, and that its pursuit should cease after abundance has been reached. We're left with the question, how much wealth do we need to live wisely, agreeably, and well? How much wealth will suffice to get us off the growth treadmill? And to answer that, an economist needs to become a philosopher, and economics a philosophical as well as a mathematical project.
Yes, I mean, the contrast between Keynes as the economist of abundance, who can actually begin to theorize, think it worth theorizing, the consequences of abundance, is the basis, I think, of a really very, very interesting contrast with Smith. Smith is not dealing with a world in whose productive resources can be described in terms of abundance.
Back to this very interesting contrast between scarcity and abundance, the whole of classical economics was based on the idea of scarcity. I mean, that was its central root. All the logic flowed from that. And therefore the idea of abundance sort of never occurred. And it's interesting how, and Keynes, what Keynes did was to say, well, let's think about, not just in terms of utopia, but let's talk about a surplus of resources at various points rather than a scarcity of them. What sort of economics do you get out of that? And I mean, you got out of that, you got the general theory, as a matter of fact. What's happened today is that we've reverted to scarcity economics. I mean, Osborne is a classic scarcity economist. We don't have enough money to do these things. The fact that there is a rather large surplus of unused resources is not a thought that I think ever occurs to him. Or if it does, they're not really surplus. In some way, we are at full employment, actually, in some way, and therefore we're in a world of scarcity. So you have this sort of break in economics, and now I think the dominant mood is austerity, scarcity, prudence, saving, back to the womb of saving, and out of this we will scramble out of the hole which extravagance has brought us into. A new classical economics fear behavioral economics, because it sort of opens up the whole story of human nature in a way that was closed down by the scarcity perspective and the self-interest, that sort of thread that comes out of Adam Smith. You see, I mean, I do love Adam Smith in a way, but I do think there were certain things he didn't do quite right. The family itself is not an independent unit. I mean, when Margaret Thatcher said they're only individuals and their families, you know, there's no such thing as society. Well, society is also a code word for community. But you can start from a different premise. And the fact is that the Chinese do start from a different premise, a different idea of human nature, a different idea of how individuals fit in to a structure. Different from Adam Smith. It seems to me, I don't know, I may be wrong about this, that Adam Smith starts with the individual and then derives a whole lot of relationships from the inescapable individualist premise. If you can't be an individual in isolation unless you're Robinson Crusoe. You live with other people. You form ways of living with other people, which involve exchanges. It's a reciprocal thing. But then there's another, it's where you start from, and he started in a particular place, and I think it's a very valuable place to start from. But it's not the only place you can, and it doesn't explain everything about human nature. Keynes's rebellion against classical economics was Ricardo. He said Ricardo was the big wrong turning, in his view. Why exactly Ricardo was the wrong turning, I don't know, because the scarcity perspective, which Keynes really abandoned implicitly in his economics as a universal condition, was there in Smith. And Ricardo hardened it. Anyone who says his aim in life is to make money invites the obvious question, what for? Money is for something. It's for something. Economists say neutrally that its purpose is to get us what we want. Moral philosophers say that its purpose, apart from satisfying our needs, is to enable us to live well. Now imagine a state of affairs in which goods are so abundant that no one needed to work. Most people would regard this as purely utopian. Yet, it was exactly this prospect that Keynes conjured up in his little essay in 1930 called Economic Possibilities for Our Grandchildren. Keynes's thesis, in brief, was that capitalism was solving the economic problem. He reckoned that if capital accumulation and technical progress continued at their current rate, they would produce a 2% growth per year, with population leveling off in 3 generations, roughly 100 years from 1930, we would all have a standard of living between 4 and 8 times as high as people did in 1930, obtainable at a small fraction of the effort. When this state of abundance had been reached, he thought that we might still want to work 3 hours a day, as he put it, to satisfy the old Adam in us. But otherwise we would be free to live like the biblical lilies of the field, that toil not, neither do they spin. Or more soberly, mankind would then come face to face with its permanent problem, which is how to live, I quote, how to live wisely, agreeably, and well. Keynes was here giving voice to the oldest of utopian dreams, of a society from which the burden of toil has been lifted. And he was saying that science and technology were bringing this about. Notice, though, that Keynes wasn't saying that X thousand pounds was enough in some objective sense. He was simply suggesting that when people's income reached X, they would signal it was enough by giving up work. So how well has Keynes's projection of the future turned out? Let's take it on 2 dimensions, economic growth and hours of work. Keynes, it turns out, was a superb growth theorist well before growth theory became part of economics. For the developed world, his forecast of an annual 2% growth per year was a little conservative. In fact, the world has grown, or the developed world has grown by about 2.5% a year since 1950. But he was writing in 1930, at the beginning of, in the middle of the Depression, so it wasn't surprising that he was a bit more pessimistic than turned out to be the case. But broadly speaking, he was right. And this translates into the following growth rates per capita, this 2% growth a year. Could I have slide 1, please? And you can see that Keynes's forecast is in blue. The actual growth of the United States is very, very similar, and Europe, Western Europe, grew faster. Now, in the year 2007, UK per capita was £23,000, UK per capita income, between 4 and 5 times higher in real terms than in 1930. So we're well on target for an 8-fold increase in living standards by 2030. And that's despite the falsification of some of Keynes's assumptions, like there wouldn't be a major war and there wouldn't be population growth. So there he's fine, really. But what about the hours of work? Like all economists, Keynes treated work as a cost for getting a desired bundle of goods and services, and as productivity went up, this cost would come down. Therefore, people would work less. Here, Keynes's projections were less successful in a particular way, and could I have slide 2 to illustrate that? In 1870, people in Europe worked on average 3,000 hours a year, also in the United States. And that was the peak. It had actually gone up during the Industrial Revolution, and then started to come down again from about 1870 onwards. By 1930, when Keynes wrote his essay, annual working hours were dispersed in a narrow range between 2,213 in the United Kingdom and 2,371. These are hours worked per year, per person. And they dropped by 30% by that time. After the Second World War, they kept dropping, but at a slower rate. Then from about 1990 onwards, they stopped falling, having roughly halved from 1870. In short, productivity, or output per hour of work, has gone up by much more than the fall in hours per person. You'd expect it to go up by somewhat more, but not by as much more. And today, average hours worked in the developed world, I'm talking about the United States and Europe, come to about 35 hours a week, and can't reasonably be expected to fall to 15 hours a week in 20 years' time, as Keynes thought they would. Americans and Japanese remain more workaholic than Europeans. And the result is even less impressive when one considers that there are many more women in the labour force than before. Women work on average fewer hours than men and would tend to bring down the average number of hours worked per person, even as it brings the total number of hours worked up. This slowdown and then breaking trend from 1919 onwards has called into question Keynes's vision of the inexorable passage to a workless future. So he leaves us with a question. Why have hours of work fallen less than he expected? Why have they stopped falling? What keeps our noses to the grindstone? Well, we can divide our explanation into 4 parts, and perhaps you could be kind enough to get slide 3 up. And I call these the intrinsic incentives to work, structural and cultural incentives to work, social incentives to work, and the last one, the insatiability of wants. Now, Keynes has been criticized, of course, for underestimating both the pleasure and moral attraction of work, and in particular the attractions of business life. He was notoriously he rated business rather low as a vocation, and so it suggested this influenced his views on the attractions of work. Well, the intrinsic satisfactions to be got from work are said to include the Promethean urge to improvement, the stimulation of new challenges, the pleasure of craftsmanship, and the sociability of the workplace. Hume pointed to people's intrinsic desire for liveliness. Because Keynes treated work as a cost, this is the way the criticism goes, he failed to recognize that technological progress was making work less unpleasant relative to leisure, and therefore would increase its attractions, relative attractions. And 2 writers have said that the trend Keynes failed to foresee was not to a state of worklessness, but to a state of joyful work. Work would become joyful. Technology would make it joyful. The rosy idea that work is becoming more joyful has been challenged by those who argue that it is becoming less satisfying for the majority in recent years. Automation has robbed jobs of most of their craft and most of their sense of achievement, replacing them by largely meaningless service jobs. As for the majority, writes French sociologist André Gortz, work no longer signifies an activity or even a major occupation. It is merely a blank interval on the margins of life to be endured in order to earn a little money. Well, which view does one take? In our view, Keynes was right to stick to the traditional assumption of work as a cost incurred in order to obtain desired goods and services, and that, for the majority, such satisfactions as necessary work itself provides are incidental to this, even though work itself might be becoming less irksome. So I think that was the right view to take of the relationship between work and goods. Now I turn to the second, structural and cultural incentives to work. Textbook economics tells us that the choice between work and leisure is an individual one. If A works harder than B, it's because A prefers income to leisure and B prefers leisure to income. But this doesn't explain why Americans work harder than Europeans, even though the standards of living in the two societies are more or less the same. A recent survey pinpoints the difference between European and American attitudes. Asked whether they wanted to work longer hours, the same hours, or shorter hours, 21% of Americans said they wanted more hours, 42% the same hours, and 37% fewer hours. Asked the same question, 7% of Swedes only wanted longer hours, 31% the same hours, and 61% fewer hours. The Swedish attitude is replicated in surveys throughout Europe. Two obvious explanations for these differences present themselves. The first has to do with the structural characteristics of the labor markets in the two societies, and the second with something more nebulous, which we call culture. American economists, trying to explain why Europeans work less hard than Americans, assert that the Europeans suffer from a frustrated work preference. The European labour market is structured so as to limit the hours people can work, and this in turn limits the rate of growth. The contrary view is that Americans suffer from a frustrated leisure preference. Many would like to work less, but the character of the American labour market drives them to work longer than they would want to. Well, of course, you can make a case for both arguments. It's true that European labour legislation has limited the amount of hours worked. For example, Lionel Jospin introduced a 35-hour week into France, and there in Holland. You can point to and the European work directives and so on. Their tendency is to limit the amount of number of hours people can work. But is it true that a deregulated labour market gives a truer picture of people's preferences as between work and leisure than a regulated one? I don't think that case is at all made out. In 1993, the Harvard economist Juliet Shaw wrote a path-breaking book, The Overworked American: The Unexpected Decline of Leisure, in which she identified specific features of the American labor market which pressured Americans to overwork. And that's a very good book. And in her essay, Towards a New Politics of Consumption, Shaw makes the connection between frustrated leisure preference and exaggerated consumption. I'm going to quote a bit from that. The standard model, she writes, assumes that employees are free to vary their hours and that whatever combination of hours and income results represents the preferences of employees. But if employees lack the opportunity to vary their working hours or to use improvements in productivity to reduce their work time, then we can in no way assume that the trajectory of consumption reflects people's preferences. There may well be a path for the economy that involves less work and less stuff, and is preferred by people to the high work, high consumption track. But if that option is blocked, then the fact that we can spend a lot can no longer be taken ipso facto as proof of our inherent consumer desires. We may simply be doing what is on offer. Well, you know, when you talk about labour market institutions, they're quite hard to divorce from the general culture of the society. Well, one economist, Axel Lenhufvud, has noted, you may say this is anecdotal, but you know, it can be done. You know, surveys often tell us what we already know, don't they? Italians have less female labour force participation, work fewer hours, take longer vacations, retire earlier than their American counterparts. They also enjoy their food and the talk that comes with it more. By contrast, American workaholism, you could say, is based on the culture of immigrants. It's more achievement-oriented, with consumption as confirmation of success. In the jargon, American history has given Americans an endogenous preference towards consumption, and the Europeans an endogenous preference towards leisure. However, survey evidence suggests that the Americans are less happy with their work-treasure trade-off than many American economists believe. But how much can culture explain? Before the 1960s, the United States was among the developed countries with the shortest working hours. Unless there's some argument to make about a reversal in culture, which might be associated with the Reagan-Thatcher revolutions, cultural arguments can't do the work that is needed to explain their longer working hours, because they didn't used to be longer. Now let's take social incentives to work. Transcending particular labour markets and cultural biases, social changes since Keynes's day have tended to keep up the hours of work in ways he didn't anticipate. The chief of these are increasing longevity, increasing inequality, and the increasing cost of leisure itself. People in most of the world live on average 20 years longer than they used to, than they did in Keynes's day. In Western Europe, the old age dependency ratio has gone up from 18% in 1960 to 28% in 2010, and it's projected to reach 51% by 2050. The increasing gap between work and death, known as retirement, means that people must work harder to support themselves in old age. Put another way, the income Keynes would have deemed enough now has to be spread over an extra 20 years to cover the additional and increasing years of productive inactivity, not to mention the increasing cost in terms of medical advances and treatment of prolonging life, the demand for which seems to be insatiable. A second factor keeping up the pressure for work is surely the increase in inequality. Keynes's projection was of average income per capita. This has indeed risen in line with productivity, but the fruits of the gains in productivity have gone increasingly to owners of capital, especially since the 1980s. This has postponed the coming of abundance for the majority. Could I have the next slide, please? Which is a Gini coefficient, and it plots the increase in inequality, the higher the percentage, the greater the inequality, since 1977. And you can see in America it's gone up. The biggest increase in inequality in both the UK and the United States took place roughly from 1980 to 1991. And then in America it went on going up. In Britain it sort of tended to flatten out. And then in Europe, you can see, we haven't got all the data here, but you can see it also had a tendency to rise. And, you know, you can show exactly what happened to shares of income. And basically, the top quintile just got more and more, and the remaining ones didn't get less and less, but they didn't go up nearly in proportion. Then could we show the British case? Please, in the next slide. And this is the Gini coefficient for Britain. Now, it's the highest, the inequality is higher in Britain than in any other non-ex-communist European Union country. The ex-communist countries have special features. But here, it's 34%, whereas the average in non-communist, non-ex-communist Europe is 28%. Then, if we then take the next slide, fifth slide, this shows the difference between average and median income or GDP over this period of time. Median wages for American males in their 30s were lower in 2004 than they were in 1974. God, I hope the graph shows that. Probably doesn't. No, it doesn't. Why have I got that down? But anyway, what you can see is that there's a very, very slow growth in median incomes, and in fact, even a slight fall at the beginning years of this century, whereas average income keeps going up. Median wages for American males in their 30s were lower in 2004 than they were in 1974. Real wages for most Americans have stagnated since the 1980s, and the vast majority of American households can scarcely make their ends meet. Now, to summarize this strand of the argument, the huge expansion of wealth at the top of the income scale has boosted the per capita GDP of contemporary societies, but depressed their median incomes. And this has gone together with growing insecurity of employment and the increase in unemployment and part-time employment, not as a result of voluntary choice for more leisure, but as a result of a decline in the number of available jobs. Now, there's an important implication of this. The more unequal societies are, the more likely they are to experience a positional competition for relative gains. There's another interesting implication. Advanced countries with higher inequality exhibit greater hours worked and a greater desire by the population to work more hours. In other words, the higher the Gini coefficient, the more the annual hours worked. And that brings us to my last slide, please. You can see there's a significant correlation between hours worked and the rise in Gini coefficient. A third reason for the failure of hours to fall is less obvious. Improved technology doesn't only raise the productivity of production, but also raises the cost of leisure. Although their cost has been falling, a plethora of technically sophisticated goods are being produced that require more money than time to be enjoyed. Most traditional leisure didn't involve nearly as much consumption relative to income as it does now. Income was spent on basics, with a fringe left over for leisure. In other words, people entertained themselves much more. So technology has determined the form which leisure takes. And the form leisure takes influences the number of hours worked. Well, what we've been saying so far is that most people continue to work longer hours than Keynes expected because they have not, in fact, achieved their consumption goals. They are compelled by circumstances to work to realize the expectations which are continually being disappointed. But that's not the same as saying that their consumption goals are insatiable, only that Keynes's utopia has been postponed. However, we now come to the possibility that his utopia is unobtainable within his own framework because wants are insatiable. Keynes thought that as our consumption is satiated, we'll work less. The flat line of hours worked since 1980s seems to refute this. We can't assume that all workers in our society have a frustrated leisure preference. Some seem happy working longer hours for higher salaries. Why is this? Well, psychological explanations of the barrier to the fall in hours claim that people work as hard as they do because they want to. This leads us to inquire into the origin of this want. According to the psychological account, what keeps people working is not the remediable frustration of limited wants, but the delusive nature of insatiable wants. And there are a number of different forms of insatiability, and they should be distinguished. First, a repeated experience gives diminishing pleasure. Hence, there is a continual quest for new experience. Keynes assumes stable consumption demands, but while satiation might occur for a given type of product, the sheer mass of new products create new desires and new demands, requiring increasing doses of human effort. This form of insatiability doesn't depend on interpersonal comparisons. Robinson Crusoe might experience it. It's the rising demand for quality that's insatiable, itself a product of rising incomes. Second source of insatiability. Individuals' sense of well-being depends not on their absolute level of consumption, but on their consumption relative to others. This gives rise to the rat race. They get more goods but get no happier, since everyone is getting richer as well. Keynes himself recognized that needs were of two kinds, absolute and relative, and that the latter might be insatiable. But he underestimated the weight of the relative needs. In fact, he mentioned them and never referred to them again in his argument. The three main examples of relative demands for consumption are the bandwagon effect, the snob effect, and the Veblen effect. The bandwagon effect depends on the fact that others have the goods one wants. The snob effect depends on the fact that others don't have them. And the Veblen effect on the fact that they're expensive and known to be expensive. Together, these effects produce an infinite escalation. The perceptions involved don't have to be conscious. And in fact, they operate unconsciously. Advertising inflames all three. There's a page in the magazine The Week. I don't know whether you read The Week. The Guardian, I think, is responsible for producing it, which suggests gifts for those who have everything. For example, for £295, you can buy a fun 3D alphabet for your kiddies, with Granny popping out at the letter G. And so on. The production of unnecessary commodities, which give a moment's pleasure before becoming rubbish, is an important mainstay of our economy. Under the extreme version of the relative consumption hypothesis, where well-being depends only on one's relative consumption, increases in incomes have no effect on leisure, since higher incomes don't increase the psychological sense of well-being. And third, the demand for income might well be insatiable even if demand for goods isn't. This is due to the existence of positional goods in Fred Hirsch's original sense. Fred Hirsch was my predecessor as professor of international relations at Warwick. He died tragically young, but he wrote a very important book in which he developed, really originated the concept of positional goods, which can't, by their nature, they're absolutely scarce. And these aren't to be confused with snob, bandwagon, or Veblen goods. They're not goods, the demand for which is relative to the consumption of others. And so there are other things, other kinds of insatiable demands for earned income. Insatiable demand for goods, which you can go through, and you sort of feel that if you're dealing purely with the world of wants, that there's no way of limiting them. And money is another huge cause of the overshooting of wants. As the Bible recognized, the love of money is the root of all evil. This is because the existence of money strengthens the desire for abstract gain at the expense of the desire for concrete enjoyment. Keynes wrote, "We ought more often to be in a state of mind, as it were, of not counting the money cost at all. We want to diminish rather than increase the area of monetary comparisons." Since Keynes's day, the tendency has been the opposite of what he wanted. In the hugely expanded financial services sector of today, money makes money by buying and selling nothing but itself. So I reach my conclusion. If wants are in fact insatiable, what chance have we got of getting off the growth treadmill? The starting point of any answer to that kind of question is surely to distinguish between wants and needs. Wants may be insatiable, but not all needs are. Stiglitz believes that the American system has created an insatiable set of wants, which ensures that the economic problem will never be solved, so that matters of greater and more permanent significance will continue to be sacrificed on its altar. Similarly, Shaw believes that the insatiability of wants is the artifact of a particular kind of economic civilization, one that produces an ever-escalating consumption norm. But this is because the adequacy of wants is analyzed on the basis of human desire rather than human need. The state exploits the insatiability of wants because it can offer its citizens nothing better than more stuff. Quantity of stuff replaces quality of life. Without a different framework for understanding what is enough, all attempts to achieve adequacy or enoughness will be self-defeating. Thus, while insatiability may explain our continued addiction to work, it doesn't justify it, since it is itself irrational. We should not be cowed by the orthodox veto on passing judgment on wants. If our problem lies not simply in the frustration of wants, but in the socially produced wants themselves, then it's not amenable to straightforward legislative solution. What is required is a change of values, a revival of the idea of the good life. What this might involve and what it should reject is the subject of our book and of Edward's lecture. Thank you. In post-war years, Hayek came to be revered as a philosopher of freedom, but marginalized as an economist, because he lacked both a model and a policy. I just want to conclude by looking at this debate in the light of what's happened in the last 2 or 3 years. Because it's resurfaced again. These traditions are the only ones that have anything really interesting to say about the causes of the recent Great Recession. For those who believe that the market economy is adequately self-regulating, a collapse of the kind we have just experienced must be due to exogenous shocks, and this is the setting for the money glut explanation. On the other hand, the alternative saving glut theory of the slump is derived from the Keynesian view that slumps are caused by saving running ahead of investment. So you have this sort of replay, in a way, of these explanations. There's a sense in which Hayek and Keynes are closer to each other than either are to the new classical economics, which has for so long been mainstream, and that's because they both recognize the crucial importance of money. They both rejected a method of theorizing which ignored the role of money, banks, credit risks, defaults, and so on. Admittedly, they explained the role of money in different ways. For Hayek, it remained essentially a disturbing force in an otherwise smoothly adjusting barter-type system, whereas for Keynes, it was the store value function of money which was key, based on the existence of inescapable uncertainty, and that explained the instability of investment, liquidity preference, and their consequences for the equilibrium of the real economy. I just want to say a last word. It's often said that a Hayekian approach sheds more light on the recent financial collapse than a Keynesian one. This is true in one respect. Hayek would not have thought that price stability indicated a lack of inflationary tendencies, and that's a central proposition in his theory. Therefore, he would have been more alert than recent monetary managers have been to the build-up of unsustainable asset bubbles. But on the other hand, I find it difficult to characterize the housing bubble and concomitant debt-fueled consumption as an example of Hayekian malinvestment, since they did not involve investment in intermediate goods. Absence of uncertainty is the big lacuna in Hayek's system. Things can go wrong because credit creation fools investors about the risks they run, not because they face a genuine unknown. And here I would say Keynes's distinction between risk, which is measurable, and uncertainty, which is not, is crucial to his economic understanding and distinguishes it most sharply from the conventional view that recent banking collapse was caused by the mispricing of risks. Nevertheless, in attacking the current method of doing economics, Hayek and Keynes would have been in the same camp. But Keynes would have gone on to say that we need to develop a model of the modern macroeconomy which takes uncertainty seriously, and therefore I believe that his was the more radical critique. Thank you.